In 2017, between 450 billion and 600 billion is the estimated cost of cyber attacks globally. So how do you see the sort of financial impacts affecting a company's cash flow over time?
Well, Giles, it's increasingly complex, companies having to deal with this evolving cyber security threat. And it's very specific, I think, to each industry and business model. Historically, when I think about cyber risk, I think about someone stealing information. But really, it's so much more broad than that. If you're a coffee shop and your payment system goes down, that means you're not able to take card payments, you lose revenue, and you're probably still paying staff and suppliers. That has a cash flow impact, clearly. If you're a manufacturer and you're fall victim to a phishing attack, that means you may pay a fraudulent supplier. Or if you have some sort of ransomware, it could actually impact your entire production process, which will have a long-term impact on your cash flow, potentially your reputation, and even your credit worthiness. If you're an online retailer, as another example, if your website goes down, then you're also going to lose revenue, you're going to lose payments, you may also lose customer information.
And as we start to see the emergence of what they call the IoT, the Internet of Things, and we connect more and more of these devices, the financial aspects of this are going to become increasingly important, whereas in the past things were sort of fixed within the IT department. Now the whole business is really going to suffer. So, I mean, how do you go about planning for some of those financial impacts that you might see within an organisation after a cyber attack?
The reality with a cyber attack is that when you're in the throes of it, there's often a limited amount you can do. So really it requires planning and forethought, and that's really our challenge to companies of all sizes, is they have to undertake some sort of risk assessment. There's got to be a policy or just a basic strategy around cyber risk, evaluating the risks that are specific to their industry, and then doing a likelihood and impact assessment. And once you've done that, you can then sort of actively manage those risks by transferring them, avoiding them, or reducing them. Practically, what that means for any company is that the finance or the treasury department needs to work along with IT. They need to be involved in the assessment, the risk assessment of their financial systems. But they also need to include all of these scenarios that are specific to the industry. They need to include that in their cash flow forecasting, their scenario analysis, or for larger companies, their liquidity risk strategy. The big challenge for companies really is to shift thinking just away from IT impacts to the financial impacts. Because for every operational system or process, there is a financial impact. Understanding those short-term risks and impacts to cash flow is absolutely critical. And cyber risk, cyber attacks is just another element in understanding working capital and cash flow.